going to get into some notes, and then I have some activities that we're going to do all along the way. I will be having you guys turn this in online. So just get all that stuff ready and let's get to it. All right, guys, we're going to start out on this slide here. So if you would, just do me a favor, a quick note, just go ahead and copy down the title, corporate structure, and the chain of command. And then we're going to go over this chart. You guys actually already have, I've given this to you and asked you to answer a question on an assignment before this, but I'm going to go in and breaking it down and kind of explaining it today. So as you copy this down, I'm going to go ahead and just get into the notes, and then we'll move on to the next slide. I think there's a total of 9 slides, and we'll roll through this as fast as we can. Here's our goal. You actually already learned about the 3 types of business organizations, right? Sole proprietorship, partnership, and corporation. Well, now we're going to do a deeper dive into corporation because there's a lot more detail about it that you need to know. All right, ladies and gentlemen, here we go. We're going to deep dive into a corporation now. And you guys have already learned about, like I said, the 3 different types of business organizations, a sole proprietorship, partnership, and a corporation. But now what we're going to do is do a deeper dive into a corporation, not just learn the definition of it, but learn the ins and outs of it, okay? Because there's a lot more detailed information. First, we'll start out while you guys are copying down this information. While I'm talking, I want you to copy down all this information on this slide. And remember, we've got about 9 slides that we're going to copy. If I underlined something or I highlighted it or circled it, you do the same thing. Just copy everything you see word for word that's on my slide here. Now, if there's a picture or image, you don't have to worry about copying that down unless I direct you to do so. All right, while you're copying that down, I'm going to go ahead and roll through and give you some information, kind of bring this to light, make it a little easier on your mind, okay? All right, corporation, why do people incorporate their business? Well, it's going to give them limited liability, right? And so if there's ever any debt damage or loss that occurs within a corporation, they can't come and sue you. Somebody can't come and sue you and come after your personal assets, right? They have to sue the company. What am I talking about? Well, in the eyes of the government, a company, a corporation is going to be seen as an actual person or a separate entity separate from you. So compare that back to when we learned about a sole proprietorship. You have unlimited liability, right? And that means you're on the hook for any debt damages or losses, right? So if something happens, they can come after your house, your car, those kind of things, where in a corporation, your business is incorporated and exists separate from you. So anyway, long story short, it kind of ties into the second line here. A corporation can own property, it can pay taxes, it makes contracts, it can sue and be sued, just like a human being, right? But what that gives is it gives an individual person protection separate from the company. So again, something happens, they're not going to come after your personal assets, they're going to go after the company, okay, and sue them. So your personal assets are protected. That's why people incorporate. Okay, let's go down here to the bottom now. And how would you go about, if you wanted to incorporate your business? I keep telling everybody in the class about Tony's Get It Done Lawn Service, right? And literally, this is how it would work. If I wanted to incorporate my business and take it from a sole proprietorship and turn it into a corporation, these are the steps I would take. Okay, this is what your textbook said, right? You have to fill out, just like you would go get a job, you fill out a job application, you fill out an application called Articles of Incorporation, okay, and you submit it to the state, okay, the state that you're in. So we're in the state of Florida, you go see a lawyer, you pay him some money, and you fill out an application. And then what happens is, when it goes to the state, if they approve you to turn your company into a corporation, they will issue you something called a charter. And a charter is a legal authorization for you to basically become a company. And that also is going to a corporation. It's going to give you permission to do things like sell stocks. Okay, and we'll talk more about stocks in just a minute. But remember, one thing that is one big difference between a corporation and a sole proprietorship, besides the liability, is going to be when you got to raise capital, when you got to raise funds. Me, the individual sole proprietor, I have to go get a loan. Or if my credit stinks and the bank won't lend me no money, I got to have a rich grandma or something like that, right? That has some money laying around or something, right? raising money is difficult as a sole proprietor. Where as a corporation now, you're legally allowed to sell stock. So you can, if you got to raise money for product and development, or you want to expand or buy some new machines, equipment, buildings, whatever, you can sell stock in your company, and that money that that you receive, you can use it to invest in your company and do what you need to do with it. So it's a little bit easier. You don't have to depend on your credit score like an individual person would. You could just sell rights to future profits, which is what stock is within the company. Okay, I'm going to go ahead and move on to slide 3 now. This is number 3 out of 9. Guys, keep copying down what you see. Keep copying down what you see, okay? All right, again, a corporation is a business owned by many, many people. Remember, just to compare that back to what you guys did with your foldable, sole proprietorship, business owned by one, right? One person. Okay, partnership, 2 or more people. And then we're going to say a corporation is going to be owned by many. Many could be, you know, as 3, 4, 5, all the way up to 1,000. You know what I mean? I'm going to show you here in just a minute, get into more depth about what that actually means, the word many, when we look at a corporation. Okay, more information about a stock. A stock is basic ownership in the company. It entitles you to future profits of the company. Okay, so basically think about wealthy people. They want to take their money and they want to invest it into stock, and then let their money work for them. So it's kind of a little different than, you know, I'm a teacher and I go to work Monday through Friday, and that's how I get paid. Well, investors, people that own stock, is they invest their money, and then they let, like stockbrokers, right? They let them invest their money for them and put money into different companies stock-wise. And then as those companies are successful and make money, they pay out what they call a dividend. We're going to go over here in just a minute, right? But anyway, that's your money working for you. You didn't actually have to show up to the job and do the 9 to 5 Monday through Friday thing. You just essentially let the company borrow your money, and they turned out a profit with it. Now that entitles you to future profits. Now we're going to talk about here in just a little bit about where some stocks give you certain things where other stocks don't. There are different types of stocks, but at the end of the day, if you own just one share of stock, you're considered part owner in the company, right? Now that doesn't mean you get to make a bunch of decisions now, right? But if the company's profitable, it does entitle you to future payouts that the company pays to shareholders or stockholders. Okay. All right. Speaking of shareholders and stockholders, that's the next term here. Okay. Shareholders or stockholders own a piece of the company, and this is just giving you an example. The amount of stock. I mean, we watch Shark Tank all the time, you know, and they're always talking about 10% of the company and 15 and 20% of the company. You know, what are they talking about? This is kind of breaking that down for you. And the more stock you own in a company, the more decision-making power, or the more that you have, or the more entitled you, the more you are entitled to getting more of the company's profit at the end of the year, essentially is what that means, okay? And so, for example, it says the amount a stockholder owns of the company depends on how many shares of stock that they own. So let's say that if there was a company that sold 1,000 shares of stock and you own 10 shares, okay, you would own 1% of that company, okay? So that means whenever that company's profitable, you're entitled to about 1% of that, okay? And so your money is making money for you. Okay, speaking of that payout, we call it a dividend. Every year when a company, and I keep saying every year, I need to stop saying that because businesses pay out at a different time. We'll talk more about that on another slide that I have. But just in general, okay? Just in general, we'll say a dividend is going to be a payout to the stockholders from the company, okay? So let's say a company pays out a dividend on an annual basis, right? That means every year the company reports how much money that they made, the profit that they made, right? And then they're going to turn around and send a portion of that money to their stockholders in what they call a dividend. You guys that did the foldable for me, remember this is one of the disadvantages of a corporation is double taxation. So, you know, at the end of the year, the company itself has to file income tax. It's taxed by the government, right? Based off their revenue and their income, right? And then the dividend that's sent to the stockholder, that's also taxed. So the government's actually double dipping in the company's profits. That's going to be a major disadvantage of this corporation. But anyway, that's how people make money with the stock market is making a dividend. We're going to talk about another way here in just a little bit of making money in the stock market as well. And I got a little video here I want to show you. I'm going to hit pause, and I'm going to show you a little video real quick, kind of explaining a little bit more depth about a dividend. All right, we're going to go ahead and watch this quick little YouTube video on what is a dividend. I think it's appropriate, and so I'm going to hit play. It's about 2 minutes and 55 seconds. Hang in there.
Hey guys, welcome to LumoVest. If you've been reading about investing, chances are you've heard people throwing around the word dividends. In this video, we'll explain what a dividend is. If you haven't yet, subscribe to our YouTube channel so you get all our videos helping you become a sophisticated investor. A dividend is a distribution of a company's earnings to its shareholders. It's one way investors make money from stocks. Most companies make this distribution through cash payments that they deposit into the shareholders' brokerage or bank accounts. However, in some instances, some companies may distribute dividends through stocks instead of cash payments. Basically, the company giving you extra shares instead of cash. But if you really want the cash, you can just sell the stocks the company gave you and you'll get the cash. So either way, dividends are really just distributions of the company's earnings to their shareholders. They do this because the shareholders are the owners. They're entitled to the corporate profits. The more money the businesses make, the more they can pay out to their shareholders. Think of Apple, for example. Apple makes money by selling its iPhones, iPads, iWatches, and tons of other products. The cash it receives from these sales will be used to pay for its expenses and reinvestments into the business. But whatever left over, Apple can give back to its shareholders. So if you own shares in Apple, the more products Apple sells, the more money it makes, and the more dividends it can pay you. That means while you're going about your day, and even while you're sleeping, the companies that you invested in are working hard on the side to make you money that they can give you in the form of dividends. The amount of dividend that each share is entitled to is known as dividends per share. You can find this information usually on the company websites. Not all public companies pay dividends. Some companies aren't profitable, so they can't afford to pay dividends. Other companies have better ways to spend the cash than giving it back to investors, like reinvesting into the business or repaying debt. We explain this in greater detail on our LumoVest website. But the public companies that do pay dividends usually pay it multiple times in a year. In the United States, public companies pay dividends on a quarterly basis, meaning every 3 months. So if you own 1,000 shares of a stock that pays $1 per share each quarter, you'll get $1,000 of dividends every 3 months or $4,000 a year. European companies often pay dividends semi-annually, or twice a year. And sometimes, companies could just lump everything together and make one large dividend payment a year. So that's what a dividend is. If you want us to make follow-up videos showing you how to analyze dividends for stocks, hit that like button. Hope you guys found this helpful, and remember to subscribe.
You do not have to recopy this. You guys have actually already did an assignment for me earlier. I guess it was this weekend or maybe last week, where I had you answer this purple question. What I want to do, though, is I want to take an opportunity here to explain to you the corporate chain of command. And then over here in the red, I kind of got this information, explanation out to the side of what are the roles of each of these folks here. So what I'm saying is I'm going to give you the option to copy down this information in red, but as long as you just listen to me real quick and you truly understand this, then you don't have to copy this whole entire chart down. Okay, it's real easy. It's easy to understand. Trust me. Okay, it looks complicated, but it's easy. Okay, so why are we even looking at this, right? So we want to look at a corporation and how it's structured. Most corporations have this big bureaucratic bureaucratic hierarchy to it. Okay, I know that was a big fancy word I just used, right? Or two fancy words. But at the end of the day, if you think about a corporation structure and relate it to how a school is organized, it is very, very similar. Okay, so at the very top, think about who our leader is, right? You have the principal. And then underneath of the principal would be the assistant principals, right? And we have an APC over curriculum, we have an APA over administration, and then underneath of them, you have the department heads, basically, right? And then, so we specialize. You think about your class schedule. You guys go to about 6 or 7 different subjects throughout the day, right? And so there's a different department for the different curriculums that we have at our school. And then underneath those department heads would be the teachers. So there's a hierarchy to it, or a structure, a chain of command, right? That our school follows, and it's no different than what happens at the corporate level. So starting here at the very top, you have the stockholders. Remember, above we talked about how the stockholders are the owners of the company, right? What that means is they own shares of stock in the company that entitles them to future profits that the company makes. They want their money to help make the company successful, so that when the company is successful and makes profit, they'll get a dividend. You see how that works? This could include thousands of people. Take a big corporation like Apple. They have thousands of stockholders, that own shares of stock within their corporation. Now, down here below it is going to be the board of directors. So if there's 1,000 stockholders, you might only have 20 board of directors. And so a board of directors reminds me of like how student government works, right? Student government, we basically, kind of select a few students, or maybe just one student from each class, and they get together as a representation of the student body to make rules, regulations, and policies for our school, right? Well, here in this situation, the stockholders actually vote for who serves on the board of directors. These are about 20 individuals, give or take, and those board of directors represent the interest of all the stockholders, right? What do I mean? Well, the board of directors, being a smaller group, what they do is they get together and they do the hiring and the firing of the CEO or the president of the company. They also set policies for the company, like are we going to, when and if we're going to actually pay out a dividend. So it's a very important role that they serve in. And so these stockholders vote for those people that serve on that board of directors. Okay, it's kind of like ownership in a football team. The Tampa Bay Buccaneers, you got the Glazers, and they do the hiring and the firing of the coach. And I see the coach as being the president or the CEO of the company, right? They're the ones that do the day-to-day managing or operations of the company, right? They hire the staff that falls below them, the department heads, and the department heads probably hire the employees that work underneath of them. At the end of the day, the president CEO is supposed to guide the team to a successful season, or guide the company to a profitable situation, right? Because at the end of the day, they're trying to make the stockholders happy. And how do you make them happy? You make the company profitable so that they get a dividend. And that's how it kind of all works in a nutshell. Very, very, very simple, okay? Now, to answer this question, it says, in this organizational chart, who reports to the vice president of manufacturing? Look over here. You have the vice president of manufacturing right here, who reports directly to the CEO. But who falls under his department or his watch? You have the purchasing manager, research and development director, and the factory manager. That should have been an easy cake question right there. Everybody probably got 100 on that one. All right, get this slide copied down. This is slide number 4. We're going to talk about an advantage and a disadvantage of a corporation. Now, I did actually talk about these earlier in this video, but I want you to write this information down. This is going to act as a review. These are things you would see on a test. These are majorly important. Okay, so I'll go over the first one, which is an advantage, and then we'll end with the disadvantage here. So a corporation, one major advantage of it is that owners in the company, stockholders in the company, they have limited liability. So what that means is if the company ever goes out of business, if there's ever any debt damage or loss, right? The company goes belly up. they're only ever going to be out the money that they invested in the company. Their personal assets are safe, and nobody can come after their house, their car, or their wife. No, I'm just joking about that, but they're protected. That's what limited liability is a good thing, and that's why people incorporate their businesses. So what's a major disadvantage? Double taxation. It's a situation I explained earlier, which is, not only does the corporation pay taxes to the government every year, but the dividend, right? The dividend, which is the payout to the stockholders when the company's profitable, it also is taxed by the government. So the government, is double dipping. Okay, so that's going to be a major disadvantage. Why is that a disadvantage? I guess if you compared it to a sole proprietorship or a partnership, and those business organization setups, those individuals that run those companies just report their income tax, or they pay their income tax like normal at the end of the year. There's no second step. So government doesn't double dip in those, but the government does do that for corporation. All right, you guys got this down. We're going to go ahead and move on to slide 5. All right, slide 5. Here we go. We're going to learn about different types of stocks. Okay, let's say you're blessed and you came into some money and you want to invest your money into the stock market, right? You want to buy some stocks. Well, when you go visit a brokerage firm to invest your money, you have a choice between being a common stockholder or buying some preferred stock and being a preferred stockholder, right? So what the heck's the difference? Well, you got to know that, and it's also important to understand in terms of what each one can do, right, within the company. So what I want you to do is copy down this chart just like it looks on your paper, and draw the circles and draw the 5 bullet points for each one. And these are the characteristics or the differences between a common stockholder and a preferred stockholder, okay? Now, I will tell you this, the first bullet points are the same, right? When we're looking at a common stockholder and a preferred stockholder, both of them are going to be owners in the company. Both of these types of stocks give you ownership in the company, right? Entitles you to future profits that the company makes, right? All right, let's focus over here on common stockholders first, okay? Remember we talked about on slide 3 here, right? The board of directors, the stockholders vote for those board of directors, right? And so if you're a common stockholder, you get to vote for those folks, right? And so that's one benefit of being a common stockholder. Here's the negative, right? There's no dividend guarantee. I'll touch more on that in just a minute when I talk about a preferred stockholder, but you're only going to get paid if the company made enough profit to pay their preferred stockholders and then has money left over. So there's no guarantee that you're going to get a dividend if the company makes a profit necessarily, right? In the event of a failure, let's say there's, the company goes belly up and goes out of business, preferred stockholders get paid first, and you only get money if there's money left over after paying back those preferred stockholders first. So what happens is a company, they go out of business and they liquidate their assets. So that anything that they own, like buildings, machines, tools, any kind of asset, they sell it. That's what liquidation means. And they try to get as much money as they can so they can pay back their investors. Well, the preferred stockholders get paid first, where a common stockholder is kind of left with his hand out, hoping that there's enough money left over. There is a higher risk in being a common stockholder, right? But we're going to get into, I believe on the 2 slides from now, we're going to get into how these common stockholders can potentially more money than a preferred stockholder through capital gains. And so I always heard the phrase high risk, high reward, high risk, high reward. So we'll talk more about that in just a minute. Let's look over here at preferred stockholders, and then we'll kind of put all this together, okay? Preferred stockholders, yep, they're an owner in the company, but they don't have any voting rights. So those board of directors on that diagram that we looked at earlier, they don't get to vote for any of those folks, right? And so they have very little little say and influence within the company and how it's run and who's running it. Okay, but they are entitled to a dividend. So there is a dividend. Let's say the company is going to, the board of directors decides, they meet and they're going to pay out a dividend to the stockholders. The preferred stockholders get their dividends first, and only if there's enough money left over after preferred stockholders are paid is when the common stockholders receive a dividend. Okay. Also, in the event of a failure or company goes belly up, these preferred stockholders get paid first after the company liquidates their assets. There is a lower risk in being a preferred stockholder because they're entitled to that dividend. They look forward to getting that dividend whenever the company does decide to pay it out. I would say in general, most companies pay it on an annual basis, but there are, you just got to look and see. Some companies pay it out on a quarterly basis or bi-quarterly, which is, like I said, every 3 months is quarterly. So, it's kind of stock by stock basis or company by company basis on how they do it. All right, let's wrap this slide up so we can move on. Common stockholders, right? You get ownership in the company. You get to vote for the board of directors. No guaranteed dividend though, right? It just depends if there's money left over from the preferred stockholders, and you only get paid if the company goes belly up after the preferred stockholders do, if there's money, enough money to go around. Higher risk, but a higher reward, right? Preferred stockholders, right? They're owners, no voting rights. They're looking for a dividend every year that they're, supposed to get. If the board of directors decides they're going to pay out a dividend to their stockholders, the preferred stockholders are going to get it. And then in the event of a failure, preferred stockholders are going to get paid first, and then it's lower risk because they're getting that dividend. All right, I'm going to play this video, and it's going to explain maybe a little better than I did on common stocks versus preferred stocks. And then we're going to wrap this up with 2 questions, a little checkpoint.
Hey guys, welcome to LumoVest. In this video, we're going to talk about common stocks versus preferred stocks and how investors make money from these 2 securities. When people talk about stocks, on TV or on the internet, they're usually referring to common stocks. That's what all companies have, and generally what people invest in when they buy stocks. But a small portion of companies will also have preferred stocks in addition to common stocks. These preferred stocks are publicly traded on the stock market, just like common stocks. So today, we're going to learn about the similarities and differences between common stocks and preferred stocks. By the end of this video, you would have developed a really solid conceptual understanding of the 2 types of stocks available on the stock market. Let's start with similarities. Both common stocks and preferred stocks are stocks in companies. When we invest in them, we're really investing in the underlying companies. Both entitle you to claim on the company's assets and profits, meaning the money that the company makes from selling its products and services is given to both common stockholders and preferred stockholders. So, how are they different? The key differences between the 2 types of stocks is mainly in terms of the investment return and risk profile. Said differently, the key differences between the 2 is how the investors can profit from the investment and the level of risk investors have to bear. Common stocks generally have higher return potential than preferred stocks. That's because whereas common stockholders profit from both capital gains and dividends, preferred stockholders profit mainly from dividends. If you don't understand the distinction between capital gains and dividends, check out our other video explaining this concept. Preferred stock prices don't move much. They're usually contained in a tight band, so most of the investment returns will come from dividends as opposed to capital gains. This is huge. This has major impact on returns. Most of the profits in the stock market come from increases in stock prices. There are stocks whose prices can increase by 50 or 100%, but dividends may only pay 2 to 6%. Once you remove the ability to profit from stock price increases, the returns profile for stocks is much lower, and that's essentially what preferred stocks is doing. So investors in preferred stocks really don't get the same upside potential as the investors in common stocks. That said, while the preferred stocks don't have as much upside potential, they also have much lower risk. Remember, stock prices can go both ways. It can go up, but it can also go down. The common stockholders bear a much greater risk in this regard than the preferred stockholders, because the preferred stock prices don't move much. So the preferred stocks have lower profit potential, but also lower risk. Another reason why preferred stocks have a lower risk profile is because companies have to prioritize giving the money to the preferred stockholders that they're entitled to every period, before they can give money to the common stockholders. Whatever remains can be paid to the common stockholders. Said differently, they have preferred status over common stockholders when it comes to the claim on the company's profits and assets. That's why they're called preferred. Let's illustrate with an example. Say a company only has $100 million of cash to pay dividends, and say the preferred shareholders are entitled to $100 million in dividend payments. In this case, all of it will have to be paid to the preferred shareholders first, leaving nothing left for the common shareholders. In this situation, common shareholders won't receive any dividend payments. But if the company has $500 million of cash to pay dividends, preferred shareholders will only get their $100 million, and the remaining $400 million will all go to the common shareholders. The takeaway here is that preferred shareholders have more certainty of their investment returns because of this preferential treatment over common shareholders. This higher claim for assets and profits further limits the downside risk for preferred stocks. Another major difference between common stocks and preferred stocks is on voting. Common stocks usually entitle their holders to vote on corporate matters. Preferred stocks, on the other hand, is typically structured without the ability to vote. So whereas common stockholders can voice their opinion in elections by casting votes, preferred stockholders can't. So these are the distinctions between common stocks and preferred stocks. Now we'd love to hear from you. Do you guys lean towards investing in common stocks or preferred stocks, and why? Leave a comment below. Thanks for watching, guys. If you like...
All right, guys. Hey, listen, go ahead and in your notes, do me a big favor and write down these two questions, and I want you to answer them based on slide number 5. Let me go back to that. Here, the two types of stockholders, go back to this slide here, and I want you to answer these two questions by thinking about that information that you wrote down, okay? So what type of stock represents ownership in a corporation? And then what type of stock gives its owners voting rights in the corporation? Write the answers to those down in your notes. And so I want to see this whenever you take a picture of your notes and send them to me. I'm gonna look at these two questions and make sure you got these two questions correct. Okay, so you can hit pause, answer them up, and then we'll get back together here on the last 3 slides. Okay, now let's take a look at how do people make money in the stock market, right? Or 2 benefits of investing in stock. Copy this slide down. We have 2 slides left and then a checkpoint at the end here. Okay, so this is slide 7 out of 9. All right, so we already talked about a dividend. You own stock in a company, the more stock you own, the bigger percentage you own, and the bigger percentage you have, that entitles you to more of the company's profit. Okay, that's one way, okay, when you get paid out a dividend like a preferred stockholder. All right, capital gains, number 2, right? What does that mean? Okay, well, let's say you own 100 shares of stock, right? And you bought it for $5 a share. Well, the price of that stock goes up, right? Well, when you go to sell it, let's say you sell it for $10 a share. You're going to make $5 profit off of each share of stock that you had. You're making a pretty good profit there. It's kind of like buying a house. A house is an investment. You buy it at a certain price. Over the years, it appreciates. You fix it up. You add things to it. You paint it up, make it look nice, and you flip it, right? And so just like you would do a house flipping it, that's how you make money in the stock market, okay? And that's called capital gains. And that means it's the difference between a higher selling price and a lower purchasing price. Okay. Now, remember the high risk part? That's possible here as a stockholder. It's where, if an investor who sells a stock at a price lower than the purchase price, that's called you're suffering a capital loss. So that's talking about the risk involved. So anyway, that's the two ways you can make money in the stock market: by receiving a dividend, or through capital gains by selling your shares of stock. All right, here we go. I'm going to teach you how to read a stock quote. Now, you own stock in a company, and you want to see how the company is performing. How is your stock doing? Are you making money, or are you losing money? Like, what's going on with the company? This is going to show you the performance of the company in real time. Okay, kind of the day before. What was the performance of the stock that you own? Okay, so every day, Monday through Friday, the business week, stock is bought and sold all throughout the day. One thing you need to know is that price of your stock fluctuates as well. It goes up, it goes down. And I know you probably have seen this on the news or on the television, or heck, even on you guys' phones. Nowadays, you'll see, green arrows going up, red arrows going down, and whatnot. Anyway, that's all just telling you information about your stock and how it's performing, how a company's performing. And so we're going to go through and talk a little bit about what is all that information you see. What does it mean, and what does it indicate to you? Okay, so this is how you read a stock quote, and I want you to not worry, first of all, about copying down this information. Just let me talk you through it. Refer back to it if you need to. You can, when I give you this next assignment, it's going to have 6 questions, and I'm going to have you take a stock quote just like this that we're about to go through and talk about what all this information means. And I want you to go back to this chart here with your questions and let it help you identify the information and identify the answer that you need to be able to answer all 6 of your questions coming up. Okay? And so here we go. How to read a stock quote, right? And so we're going to start over here on the left-hand side, okay, with this column here that says stock. Okay? First of all, each company has a stock name or a symbol associated with it. So look, back in the day before, the internet existed and all that, people read the Wall Street Journal and the financial page, right, to see how their companies do, how their corporations performing, right, how their stock's doing. And what they would do is they would look for the acronym or what they call the symbol, right? Each of the companies that exist have a symbol associated with it so you can quickly identify it. Like, for example, Walt Disney World. You would find that company as WDW, Coca-Cola, CC, right? You guys live in the world of acronyms nowadays. SMH, LOL, you guys know exactly what I'm talking about, right? So anyway, this is going to help you identify in a list of companies. You'll be able to pick out your company quickly and efficiently because you know the company's symbol. Hopefully that made some sense, okay? Like I told you, each day, right, there's an opening price and a closing price of your stock that you own. Okay, what was the opening price? What was the closing price, right? And it fluctuates throughout the day, right? Well, over here on the left-hand side, the reason I was bringing that up is because over here on the left-hand side, it's going to tell you in the last 52 weeks. If you don't know, there's 52 weeks in a year, right? So out of the last 52 weeks, you want to be able to look and see what was the highest price one share of your stock sold for, or what was the lowest price within the last year that a share of stock sold for. This is where you would find that information. I might add, let's say you don't own any stock, but you're looking into owning some stock. This would give you some information so you can do your research before you actually spend the money. You wanted to look for an attractive stock to invest your money into. These are the kind of statistics that you'll look at to help you identify what you're looking for. All right, so we got the first 3 knocked out, the symbol and the 52-week high or low, okay? Let's move on. Let's go down here where it says high and low. This information here is going to tell you, you're reading it today in the newspaper, but it's going to tell you information from yesterday, right, about your stock, okay? So yesterday, the highest price that that share of stock sold for was $45.73. That was the highest it went up to, and the lowest it was $42.20. So that tells you yesterday's high and low. Don't be confused. This is going to tell you over here the 52-week high or low, and this is going to be talking about yesterday. Okay, so big time frame differences there. Okay. Over here to the right, we're going to look at this column that says last. Okay, when the stock market closed yesterday, what was the final price or the last price that a share of stock sold for? That'll be that price right here, $44.58. Okay, so we've got the symbol, the 52-week high or low, we got yesterday's high low, and then we got the last price that it sold for. We've got all that information knocked out so far. I'm skipping around a little bit because I'm trying to knock out the easy stuff first before we get into a little bit more difficult stuff. All right, right here where it says sales in the hundreds. Okay, let me read to you what this number is. It's actually an abbreviated number. If you wanted to look at how many shares of this stock was sold yesterday, right? This is the amount, but it's an abbreviated number in the hundreds, right? So this number shows you the total amount of stock traded from the previous day listed in the hundreds. What the heck does that mean? It just means simply add 2 zeros to the end of that number, okay? So to get the actual number traded, you would add 2 zeros to the end of this listed number. There you go. So actually, this would be 1,558,400. Okay, that would be a larger number than what it is. Okay, this column here that says change, here's the deal, right? We look at this price here that says last. This is the last price that your stock sold for on that day when the stock market closed. Now, what you do is you take this and you identify what was the last price from yesterday, you subtract the two, and that's going to tell you what this number is here of change, comparing today to yesterday. And so today, it says that that stock lost 7 cents compared to yesterday, okay? So that's what the negative means there. Now, if it was a plus, that would mean that this stock closed at 7 cents higher. So you gained compared to yesterday. So that's what this column change means. All right, let's look at this column right here. DIV stands for dividend. Okay, this is going to indicate how much per share of stock that you own, right? For one share of stock, this was the amount paid out in a dividend for that one share of stock that you would own. So if you own 10 shares, you would take this amount and you would multiply it by 10. If you own 20 stocks, you would multiply this number, $1.76, by the by 20. So you just multiply by how many shares of stocks you own or would want to own by this amount, and that will give you an indication of how big of a dividend you would receive for owning this stock or stock in this company. All right, let's look at yield percentage now. This is going to be a figure or a percentage, a number that's generated that we're going to look at. It's going to basically tell us information about how much we're going to be putting in versus how much we're going to be receiving back. The higher the percentage, the bigger profit that we can make off that particular stock. All right, guys, last one here, price earnings, right? This price earnings column, PE. Okay, this is a way that investors can make a smart decision by comparing companies across a broad spectrum. Okay, you might have companies from different industries you're looking at, but you want to make a comparison of those companies. You look at this number here, and it's a way to compare apples to apples. Ladies and gentlemen, we have arrived at the last slide, slide number 9. Okay, this is going to be a checkpoint. Now, we just went over how to read a stock quote. Well, here, I created another one for you. Okay, and you have 2 different stocks here we're looking at. Okay, you're going to answer these 6 questions by analyzing this stock quote. Okay, I need to tell you some information while you do that. Include this in your notes. You don't have to copy down this chart, but you do have to answer these 6 questions. So include this in your notes that you're submitting to me. Okay. So you're going to study the stock market information below and answer the questions that follow. Okay, I'm going to read you a little something, and then I'll kind of coach you up on what you're looking to hear. Reading the financial page. To find information about stock prices and trades, you can read the stock market report on the financial page in the newspaper. Every business day, shares of stock are bought and sold. At the beginning of each trading day, stocks are bought and sold at the same price at which they closed the day before. At the end of the day, each stock's closing price is recorded. People read the financial page to follow the prices of stocks they own or are thinking about purchasing, and to monitor the strength of the country's business economy. All right, we're going to wrap this up now, guys. Last thing is go ahead and answer these questions and let me kind of coach you up on what you're looking at. Remember, you got the 52-week high or low here column, the stock with its symbol. Make sure you pay attention to the correct one. You got the dividend, the yield percentage, the PE, sales in the hundreds. Remember, you're going to add 2 zeros, okay, to this number that you generate. You got yesterday's high and low, yesterday's last price that a stock sold for, and how much it changed. Each stock changed from yesterday, from today to yesterday. Okay, might be the way to say that. All right, look, down here it says the source, right? It says this is in the New York Times newspaper on October the 28th, 2019. The reason why I'm pointing that out to you, but look at this first question. At what price did Bank One shares close on October 27th, 2019? Well, if you notice, this is a newspaper clipping from the newspaper in October 28th. They want to know information about October 27th. But look, don't freak out. This is that information. Just like you would want to know yesterday's basketball game score, you look in the newspaper for last night's game, you look in today's newspaper for that, right? And so same kind of thing. You want to know what happened yesterday with a stock, you look in today's newspaper. So don't let that throw you off, okay? This is the information you need to answer those 6 questions. All right, hit pause, look at this chart, answer those questions up, and then you guys take a picture of all your notes with these questions answered and submit them to me. What we'll do is I'll have a business organization quiz online here later in the week that I'll have you do, and then we'll wrap it up and we're moving on to the next chapter, the next unit. Y'all take care.